Hey there, financial explorers, and welcome back to the channel where we dive deep into the fascinating world of the stock market. Today, we're putting a unique spotlight on a stock that's caught our attention due to its incredibly high cost to borrow, TGHL. We're going to break down what's happening with TGHL, what a sky-high cost to borrow means, and why it matters in the context of a potential short squeeze. Stick around, because this one has some truly eye-popping numbers. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about TGHL. This is a micro-cap stock, which means it generally has a smaller market capitalization and can sometimes be more volatile or less liquid than larger companies. We've been tracking TGHL because it recently appeared on our hard-to-borrow screener. The estimated float for TGHL stands at 12.7 million shares. Now, when we look at recent price action and volume, there's something critical to note. Today, TGHL saw 0.0% change, and looking back, it's maintained the 0.0% change over the last 5 days and even the last 30 days. Similarly, today's trading volume registered at 0 shares, with a 30-day average volume also at 0 shares. This translates to a relative volume of 0x average. These numbers indicate extreme liquidity, which is a key factor to keep in mind as we discuss its borrow rates. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? In simple terms, it's the fee that short sellers have to pay to borrow shares of a stock before they sell them. Short sellers bet that a stock's price will go down, hoping to buy back those shares at a lower price later and return them to the lender, profiting from the difference. This fee is usually expressed as an annualized percentage. Why does it matter? Because a high cost to borrow tells us there's high demand to short a stock but a very limited supply of shares available to borrow. When the cost gets extremely high, it can make holding a short position very expensive and risky. Why this stock is hard to borrow right now? Now, for TGHL, the cost to borrow fee is absolutely striking. It's currently sitting at an annualized 773.1%. Let me repeat that, 773.1% annually. To put that in perspective, that means short sellers are paying over 7 times the value of the shares just to borrow them over a year. Our data shows that the shares currently available to borrow are unknown, which often implies a severe scarcity. While we don't have CTB momentum data for TGHL, the sheer level of the fee speaks volumes about the difficulty in finding shares to short. Our internal composite squeeze score, which combines various factors like CTB level, borrow supply, float size, and momentum, places TGHL at 46.5 out of 100. This score indicates a notable level of underlying pressure related to borrow costs, despite the current lack of trading activity. Squeeze mechanics explained. For those new to the concept, a short squeeze occurs when a stock's price begins to rise, forcing short sellers to buy back shares to limit their losses. This buying action can then push the price up even further, creating a cascade as more short sellers are forced to cover their positions. In a hard-to-borrow situation like TGHL, with such a high CTB, the cost of maintaining a short position becomes a significant burden. If even a small amount of buying pressure comes into stock with limited float and high borrow costs, it can make it extremely difficult for short sellers to find shares to cover, potentially accelerating any upward price movement. The high costs mean short sellers are burning cash every single day they remain short, increasing the pressure on them to exit if the price moves against them. Dilution risk check. One crucial factor to consider when evaluating any short squeeze potential is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. This can often lead to a decrease in the stock price and can significantly hurt a short squeeze thesis because it effectively increases the supply of shares, making it easier for short sellers to cover their positions. For TGHL, we checked for recent diluted SEC filings like SMINUS-1s, SMINUS-3s, or 424Bs within the last 90 days, and we found no recent diluted filings. We also found no recent reverse splits for TGHL in our look-back window, which is another factor that can impact share structure. This absence of recent dilution or reverse splits removes a common hurdle for short squeeze plays, but remember, things can change quickly. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given TGHL's unique situation with zero recent volume and price action, but an extreme cost to borrow, what should you watch for? The 773.1% CTB clearly indicates that any short positions are incredibly expensive to maintain. However, the current lack of liquidity with zero shares traded recently means that there isn't an active market to pressure short sellers right now. What would change this? Any sudden influx of buying volume, even small amounts, into a stock with such a limited float and extreme borrow fees could potentially have an outsized impact on price. It's also important to remember that a high cost to borrow doesn't guarantee a squeeze. It could also mean that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to stay short. They might believe the stock is headed even lower, making the high borrow fee worthwhile to them. So, TGHL presents a fascinating case study with its incredibly high 773.1% cost to borrow. While the current market activity is non-existent, the underlying pressure from these borrow costs is undeniable. It's a prime example of how extreme scarcity can drive up fees for short sellers. Keep an eye on the liquidity or lack thereof for TGHL, as any change could potentially impact this extremely hard to borrow situation. If you found this deep dive into TGHL informative, please hit the like button, subscribe for more unique stock analysis, and let us know in the comments below what other hard to borrow stocks you'd like us to investigate. We love hearing from you.